Good afternoon, folks. It's Dave Burrows. Thanks very much for joining us on another one of our Wednesday afternoon webcasts, Barometer readings. On the call today, what I'd like to do is just talk through some of the things that have happened over the course of the week, changes we're making in portfolio as they relate to things we're seeing going on in the market. We're not going to be able to answer questions today. We're having some technical difficulties with the Q&A, but I'll take a crack at it at the end and see if they've been repaired. In the very short run, just from our lens, we're trying to do three basic things every day in the investment team. We're using our tools to try and identify market leadership, where money is getting put to work, which areas of the market are healthy, so that we can express those views, identifying specific securities that for whatever reason are outperforming their peers, have financial metrics that are good, getting better, and where we believe they could be revalued versus their peers. So we're not trying to be everywhere. We're trying to find very specific themes. We're always watching for change. And some of the breadth work that we do helps us to recognize change before it's obvious in the indices or before you're reading about it in the press. And then, of course, there are some times when it makes sense to play some defense, to keep some cash on the sidelines, to avoid certain groups, like we have been avoiding the energy sector for quite some time. And the goal here is to be tactical, pick our spots, take advantage of strength, and recognize when there are risks so that we can play some defense, okay? We talk about understanding the environment that we're in. We like these blue periods the best. If we take a look, for instance, at the period between 1951 and 1966, or the period between 1982 and 2000, or the period from 2013 to present, these are periods where we have seen improvement in general for the equity asset class. These are periods where not only earnings were growing, but the multiple investors were prepared to pay of those earnings was rising. And so realistically, these are all important things, and we believe we're in a structural bull market. We've talked for some time that we took out the highs of 2000 and 2013, and the market has been working its way higher since. So very different environment than the period between 2000 and 2013, where you got sort of cyclical advances and declines, but the market made no progress. We certainly have had sloppiness along the way. There was a bumpiness in 2015-16, a very sharp pullback in the fall of 2018, and of course the most recent pullback, which was in February, March of this year. NASDAQ has been a similar picture. It took out the highs in 2016 and has been working its way higher ever since. It's sort of at the top end of its channel. You know, these things can correct at any time, but it's been has been the strength in the market. Now, since March, we have had an unprecedented amount of money supply thrown into the system to try and offset the contraction that's taking place in the economy. So you can see, going back to 1950, a number of periods where there were economic difficulties, and the Fed and other central bankers pushed money into the system, made money inexpensive and readily available. And this period is truly remarkable. So I think it has been a conundrum for many people to understand how the market has been able to handle such a difficult environment and work its way higher. And fiscal and monetary stimulus have been an important crutch for asset prices. When cash is readily available, then it often finds its way into financial assets before it finds its way into the real economy, which is why the market is so interested as to whether or not we could have another fiscal stimulus package, because the market is almost addicted to this stimulus as it comes along. Now, it doesn't mean that there aren't things to worry about, and the extreme amount of fiscal and monetary stimulus is partially to fault for the volatility that we're seeing in the market. So I pointed out last week that 26% of trading days this year have been moves of up or down 1% or greater, which is the most 1% moves plus since 1938. And this week hasn't been any different, right? Today is a very good day. Yesterday was a very bad day. And we don't like volatility because it means that there's a real battleground going on in the market. It's not generally the most healthy thing. We like the volatility up days the best, obviously. Now, one of the things that all this liquidity has done is it has private investors very interested in the market. There are a lot of new day traders, and there's been a lot of put and call buying. And so we pointed out in July, the number of puts that are being bought, those are things that people buy to protect a portfolio, are minuscule when compared to the amount of call buying that's taking place. And this has an impact on markets. So we talked about how there's been so many small orders for calls on the big names, Facebook, Amazon, Apple, Netflix, Google, et cetera. I mean, and how different it is than the way the market has been behaving previously. This has an impact on the severity of the moves in the market. So I just want to touch on this because people have asked me questions about this. So a new small investor decides to buy calls in Amazon. And for a relatively small amount of money, they can buy the right to buy Amazon in the future at a fixed price. So for a small amount of money, they can control a fair bit of stock. And the market maker sells him that option, but to hedge himself, buys 21 shares of Amazon to hedge. And then Amazon goes up a little bit, and the calls are worth more, and there's more risk to the market maker, so he has to buy some more Amazon shares to hedge himself. And then Amazon goes up a little bit more, and now the market maker has to buy even more shares to protect himself. So now for that $1,500 that the small investor put at risk, the market maker has in result had to buy $230,000 worth of Amazon shares to hedge. So this is causing this call buying, lots of appetite for buying a hedge. Now, if there was put buying taking place at the same time, it would all equal out. But because it's been so extreme on the call buying, it has had a big impact on market. And so when this takes place and the market starts to rally, it begets more rally, and similarly to the downside. So let's talk about the world, the lens that we look through. We always are trying to find parts of the market where we see expanding breadth, meaning as time goes by, more and more securities participate in a rally. That's a broadening market. That's money getting put to work. Our work also helps us to recognize when groups in the market are starting to run out of gas, not because the leading stocks are rolling over, but because the weaklings under the surface, the ones that are less important in the index, start to back off themselves. So when the leaders carry on, but the weaklings have started to sell off, that tells us there isn't enough new money going into the market. There is risk, and it could broaden and wind up impacting more and more securities. So we're trying to find groups where there's broadening breadth, and we are avoiding groups where we see deterioration. When we see deterioration at the market level, it causes us to be quite cautious. Now, since the end of August, we have seen fewer and fewer global equities perform well. The market has been narrowing. Not meaning that the strongest stocks are getting hurt, but the weaker ones, and that can wash through more of the market. So that's had us be a little bit more cautious. Market got volatile the first week of September. It's been up and down, and here we are in October, seasonally a weak period of the year. And there is some sloppiness in our indicators. Now, the US has been the strongest part of the global equity market so far year to date, because the sectors in the US market line up with those strong sectors. If we go around the world, European breadth is weak, Latin American breadth is weak, Asian breadth is weak. The US is starting to show some improvement. And so that is something that we think is important. Now let's look at the indices themselves. The S&P rallied off the lows in March. It had some consolidation in June and into the beginning of July. Then the market rallied from July into the beginning of September and then started to correct. We had 2 steps down. And then over the last 7 or 8 days, the market's working its way back a little higher. So it may well be, as I said last week, that it's over. And that would be great. If we could clear the highs from 3 weeks ago and then eventually get back to that's really, really good. And it may be that we've seen enough. It was about a 10% correction. But given the fact that we're in October, and given the fact that the market is reacting quite significantly to good and bad news, it's also possible that we could pull back down into this black line, which is the long-term moving average, which is where the market tends to correct to. So now that's the whole market. And of course, we're not looking just at the whole market. We're trying to target areas of strength. And there are some very good areas of strength in the market, which is why we have still some quite significant positioning on in the portfolios. The NASDAQ has been the strongest part of the market. And this is the QQQ, which is the NASDAQ 100. Again, started to sell off the 1st of September. We moved about 12% lower, and we've bounced about a half of that. And in the last week, the market has been trading in a narrowing range. So what does that mean? It means there's a battle going on in the market. There's been bad news, Trump saying we're not going to do any stimulus until after the election, the posed risk of COVID in the White House. And today, market's a little higher because they're saying, well, maybe we'll do some targeted deals. The market will break one way or the other. We still think that there is a real possibility that we could have another step lower as we work through October and some of the surprises that we may see. But if we can get up and out of that range, again, that would be really positive. And as I say, some of our indicators are starting to show some improvement. So we look below the level of the market to see what it is that's working. But just beyond the NASDAQ and the S&P, we know the Canadian stock market's still about 10% off its February highs. The makeup of the Canadian market has not been very conducive to strength. We don't have such a big technology sector. We don't have the same kind of healthcare sector that the US market has. We don't have the same long-term growth companies in general as the US market. So what have we learned over the course of the last week? Well, first of all, there is some new strength in small and mid-sized companies, companies that are tied to the US economy. So small and mid-sized companies tend to be less global by nature. They tend to be more impacted by Main Street. They have significantly underperformed the S&P and the NASDAQ until the last 7 or 8 days. And so clearly the market is sniffing something out. Now, maybe it is that there's advances in healthcare, perhaps the vaccines. It may be that the market has been hoping for a fiscal stimulus. It may be that the economic data is improving and the market's sniffing out that that may continue. But what's important is this is a broadening. This is part of the market that has not been participating that is now showing new strength. What else have we seen over the course of the last week? Well, credit spreads widened a little bit, but you can see the spike in both the green line and the blue line. That was the extra return corporate bond investors demanded to buy corporate debt in February, March, when the pandemic first hit. And the demand for corporate debt has been quite strong, and the Fed has been helping. And so the premium that people who sell bonds have had to pay to attract capital has come down, which means that the market is sensing that there is less risk to buy corporate debt or of credit default. What else have we learned? Well, the US payrolls are improving. So they're improving, but at a slower rate. So we can see that we're not near where unemployment was when this all began, but we see that the employment reports are improving. That's good. The ISM data on services, we know the service economy in the US is the biggest part of the US economy. After a sharp V bottom, the services indicators are improving. When we look at the PMI data around the world, the top right quadrant is where not only is the economy expanding, but it is accelerating. And we see that a large number of countries around the world are seeing an improvement in the PMI data. This is where we would like to see it. And you can see top right, the US. really is showing lots of strength in the middle of the country. Now, 3 weeks ago, all of our indicators were negative. Last week, we continued to have the long-term indicators on a sell signal. We were seeing some improvement in short-term indicators. And this week, we have seen some more improvement in short-term indicators and a couple of the US long-term indicators. So they're not all turned back to green, but they are certainly showing some improvement. But here's some interesting stuff. The risk model for the fixed income part of the market is weakening. Now, why would breadth in fixed income weaken? It means that there's less demand for certain parts of fixed income. Now, that's despite last week record flows into bonds. When they announced that Trump had COVID, there were massive flows into the bond market. And I've talked about the fact that I don't think it makes much sense to focus on the bond market because the yields are the lowest they've been since 1981, and frankly, 1,000 years globally. So the reward that you get for the risk that you take on of higher interest rates has not been a good one. We talked about the fact that we have been at historically low yields. Last week, I put up this chart. This is a chart of a 30-year bond in the US. The chart moving higher means that prices of bonds have been going higher, which means yields have been going lower. So through the course of 2019 and 20, rates have been falling in the long end of the bond market. Now, in the last number of months, the market has been in a narrowing range. And my sense was we were going through a topping in the US bond market. Now, if rates go up, bond prices go down. So an investor who buys a 30-year bond with, say, a 1.5% yield is going to get 1.5% for the next 30 years. But if rates in the economy go up, the price of the bond goes down and they lose money. So the 1.5% is not much solace if you're losing the value of your capital. So this week, we did break down. So interest rates at the long end of the US bond market have started to tick higher. Now that could happen for two reasons. It could happen because people are concerned about the credit rating of the US. That's not the case. There are other indicators we can look at for concern, like the price that people will pay for default insurance. They're very benign. So the other reason is that people think that as we move forward, either we're going to get higher inflation or improved growth. Both would be good for the US economy. The Fed and every other central bank are doing everything they can do by pushing this stimulus in to create some inflation. Because if asset prices go up, it doesn't matter whether it's your home or your portfolio, it means your liabilities are less onerous. So they've been trying to create a little bit of inflation. We've seen a little bit of indication of some inflation in Europe, the UK in particular. But certainly this week, the movement in the bond market was significant. So to put it in context, this is interest rates from 1981 to most recent. We started at just over 15%. In March of this year, the yield on a 10-year bond was at 70 basis points. Today it's 1.59. Just to go back to where we were in 2018 is 3%. It means bond prices would get cut on a long-term bond by 40 to 50%. So this is not insignificant. So what does that mean? It means that investors who are looking for yield might have to look somewhere else. We know that since 1981, deflationary or disinflationary assets have way outperformed inflationary assets. And they're quite distinct. Now, through the course of the year, we've talked about the fact that we think risk reward in REITs, for instance, which are really impacted by interest rates, is not good. They're overowned. People have been piling into them for years to get the dividend. But if the concern is that you could see rising rates, that makes them less attractive. So in the recovery in the stock market, REITs have really underperformed. They continue to be way below the highs. It's the same for all high dividend paying stocks that they call bond proxies, utilities, telephone companies, REITs. These are areas that we have been avoiding as a firm. Our income strategy benefits when we position ourselves in dividend growth in that kind of environment. And so that's what we've been looking for. And what we've seen in the last few weeks is dividend growth assets are now significantly outperforming. So our portfolios are targeting sectors that benefit when the economy gets better, where their ability to pay a dividend improves. I always talk about buying things that are good getting better, where they have an improving ability to pay either a rising dividend or the credit risk on the bond gets a little bit better. And we really are starting to see these groups outperform. And this is important because this is where we're positioned. But what other inflationary assets might we like to own? Well, these are some groups that are really underowned and unloved. So this is an ETF that tracks materials companies. So that's chemical companies, metals producers, basic materials that go into the building blocks of the economy. And we've seen over the last 2 weeks a sharp rise in materials companies, some better, some worse. I'll give you a couple of examples. This is the chart of Freeport-McMoRan Copper and Gold, one of the biggest copper gold producers in the world. Now, all commodity stocks made a major low in 2015. They made a secondary low or a test of the lows in March of this year. But since then have been coming charging back. Now, not all have. Freeport, the best ones always do the best off the bottom. Freeport is probably the highest quality copper and gold company in the world. It's a $25 billion business. But the basic material companies are underowned and unloved, and you can see the bottom blue line has been rising sharply. That's relative price performance versus the market. So Freeport is a large holding of ours. What else does well when there's a little bit of inflation or a stronger economy? Well, companies that make industrial products that we need for basic materials, for instance, Caterpillar. So again, this is a weekly chart. You can see that from 2017 through 2019, it was an underperforming security, but actually way better than the materials companies. And you can see that we've just broken out to a new high that goes back to 2019. And again, relative price performance moving higher. This is one of the best managed companies in the world. It's an $80 billion company. And when things start to get better, you see money get spent on Caterpillar equipment. Cummins Diesel, they have the patent on the diesel engine. And you can see, again, a highly economically sensitive stock against a pretty sloppy market, making new all-time highs. Transports in general, we've talked about transports through the course of the year and the fact that they have been acting better than the market. Certainly companies like CP, which today will close at a new all-time high, up 3%. Nice dividend attached. That is a dividend that is good getting better. This is a company that can afford to pay more to its shareholders as business conditions improve, and competitively they're doing very, very well. We also own CSX. Now those groups join established leadership in the market, which are in long-term structural disruptive themes. So we talk about trying to find those industries that are changing the world, and clean power is one of them. So solar has done well all year long, but as it has becoming clearer that the Democrats are in a better spot, clean energy is really starting to roll. Semiconductors, another basic building block of the economy, making new relative highs this week. Companies like Taiwan Semiconductor, NVIDIA, companies that we own. Companies in healthcare technology, these are the genomics companies making new all-time highs. Consumer discretionary has been behaving well over the last few weeks and is back close to highs. And we talked last week about the fact that if rates were to go higher, this would ultimately be good for banks. And that while we weren't seeing that follow through yet, it was something we were watching. Well, this week we did get some improvement in the banks, and we have Royal Bank of Canada in the portfolios, we have TD, and our financials weight is now moving higher. So healthcare and technology has been very, very strong. Energy financial is very, very weak. There is almost a historic differential between the two. And we think that we can start to get some strength in groups that have not been participating. Value has underperformed significantly. It's a group that could start to perform well. That would represent broadening. So when we look across the market, there's a number of areas that are showing improvement. Materials, healthcare continues, consumer staples, industrials, and technology. and consumer discretionary. These are the areas that we've been focusing. So our job is to do these three things: find market leadership and focus our portfolios in those areas, try to identify change and adjust the portfolio as required. And if there is weakness in the market, be prepared to avoid big parts of the market or have some cash on the sidelines. We try to be tactical. We go through each week what the changes have been. We talked about the fact that technology no longer appears to be the only game in town. So for the last few weeks, we've been reducing our exposure there. We've increased our exposure in financials. We've increased our exposure in industrials. We've increased our exposure in consumer discretionary. And we continue to have a very low weight in things like energy, real estate, and utilities. Look, we worry every day about pullbacks, and we take them very seriously. If we were to see October get sloppier, we think we're pretty well defended. We think the groups that we're in continue to act well, but we will have no difficulty whatsoever putting more defense on the field if the indicators start to weaken again. So with that, I'm going to see if there are any questions on the line and see if I can answer them.
Hey, Dave, can you hear me?
Let's see. We got a question on markets outside of the US and how they're performing. So the US continues to be the most attractive place. If we see follow through in basic materials and precious metals, the Canadian market gets better. European markets continue to be sloppy. The Japanese market is showing some strength. In fact, it's getting close to the point where the market broke down in 1990. So it has been through a 30-year bear market. So that's a market that we're looking at. But the breadth models are the best in the US. And so we focus more in the US, to a smaller degree in Canada because it's our local market and we've got some good positioning. And we watch for change. If the US dollar were to weaken from here, that would be a sign that global markets might be ready to rally. We'll look closely for that. In China, we do have some exposure to the Chinese consumer and the Chinese internet retail companies through the ETF K-Web, which is Chinese web, and CHIQ, which is the Chinese consumer ETF, which holds a number of companies that sell into the domestic market. The last question I've had here is, where does gold fit into the portfolios? We think that if we are entering a reflationary environment, gold will be an important asset. Now, it's been correcting since the beginning of September, like other parts of the market. Some investors who buy gold because they think it's a protection against disaster. Other people buy gold because over time, if there's reflation, price of gold goes higher, and gold producing companies are very inexpensive relative to gold. So I would expect through the course of this year, we will continue to have some gold positioning, and you would expect us to weight up the group once this correction has run its course. And again, it may well be close to that. So we're watching very closely. The next leg higher for the gold producers should be very substantial. And so we'll watch closely for that. I did get a question on the name of the materials ETF. FXZ is one, XBT is another. Both are quite interesting because they give you exposure across chemicals, metals, golds, basic building blocks of the economy. And the fact that we're seeing some strength there is very, very constructive, not necessarily because the economy is really ramping up, but because there's an expectation that we could get some inflation, and that would be a positive thing for global financial markets. With that, Pamela, you're not on the line today. I think that we'll wrap up. Thank you very much for tuning in. We'll look forward to updating you as our indicators improve, and we hope that everybody has a good week. Thanks so much.